G'day, hello, welcome to the introductory episode of the Aussie Crypto Podcast. Whether you're just getting into crypto or you're getting serious about crypto, we aim to have something for everyone here at the Aussie Crypto Podcast. I'm Gil, your host for this episode, and I'll kick this series off with a little introduction. I'm currently an analyst at a CeFi startup in Queensland. Prior to moving into crypto, I had a 7-year career in traditional finance, which touched retail banking, asset management, insurance, and superannuation. So, if you're listening to this podcast, you're probably an Aussie who's interested in crypto, blockchain, or both. You may have noticed that there's a lot of news and discussion about crypto, but it's very global and US-centric, so it's not always applicable to us Aussie battlers down under. In this show, I'm hoping to take the discussions that are had at a global level and talk about what they mean for Aussies. I'm also hoping to speak with a range of Australians working in crypto to give you guys insights around development, investing, taxation, and regulation down under. I'd also like to bring some discussion around up-and-coming projects in CeFi, DeFi, NFTs, and anything else that takes my fancy, the fancy of my guests, or the fancy of my listeners. Our first episode is 4 things you should know about the crypto industry in Australia. But before I kick that off, just a quick disclosure. I'm not a financial advisor, I'm not a lawyer, I'm not a tax advisor, and I'm not anyone who's qualified to give you personal advice. The views and topics that I discuss here aren't financial advice, and you should always DYOR. Do your own research. Think about your own circumstances before making any investments or get personal advice from a professional who's qualified to give it to you. The views in this podcast aren't reflective of the views of any of the companies that I work for or have worked for, and they're just my own opinion. With that out of the way, let's dive into 4 things that I think you should know about the crypto industry in Australia. Number 1, the size of crypto in Australia. Australia is really just a drop in the ocean when it comes to crypto, and there's a few reasons for that. We're a relatively low density population with a strong payment system, so that base use case for cryptocurrencies as a payment system isn't that applicable to us. Cryptocurrency really is seen as a speculative investment here. In the US, Asia, Africa, and Europe, we're seeing a lot more adoption for various reasons. The first of those reasons is payment systems. I know anecdotally that back in the day when it wasn't banned, the use of crypto for payments and transferring wealth in China was huge. This saw the birth of some massive crypto players in the market, Bitfinex and later on Binance, just to name a couple. Adoption in Nigeria and Central Asian countries for the purpose of remittances was also huge. These countries had a really strong use case for quick, inexpensive cross-border remittances, so crypto was quickly adopted there. Countries like Vietnam, Kenya, and Venezuela saw huge transaction volumes on peer-to-peer platforms because it was much easier to move wealth around than those centralized systems that were with banks. Countries experiencing currency devaluation also had their citizens stash their savings in Bitcoin and other crypto just to preserve their wealth. In summary, there were a lot more countries that needed crypto than Australia, so adoption was much higher there. The next factor behind our smaller presence in crypto is our smaller population. Naturally, with a smaller population comes a smaller pool of savings available to be invested in crypto. Making that pool of funds even smaller is the number of investment businesses and crypto exchanges and CeFi platforms that don't actually have much incentive to operate in Australia. High taxes, uncertainty around regulation, high levels of reporting make it much easier for crypto businesses just to go overseas to run their operations with less friction. The Bahamas, Bermuda, Ireland, Singapore, the Cayman Islands, they're all really popular places to set up an international crypto business. I know that some of these places probably set off alarm bells. You might think tax evasion or just be generally skeptical. But I cannot stress enough that the barriers of entry to running a crypto business in Australia are getting higher and higher as we've got a lot of consumer protection and complex regulation here. The other thing that I want to point out is that we're a relatively high cost of labour, high import and high cost of electricity country. Currently, this environment makes cryptocurrency mining an expensive endeavour, especially if you're going to build a business on mining that's trying to import parts, manage workers, and manage your electricity bill. Fortunately, the industry is acutely aware of our abundance of sun and other green resources, so there are some talks of green mining incentives on the horizon, and I'll touch on these in a later episode. Australians' investment into crypto relative to global markets is small. Aussie investors should be mindful of the macroeconomic factors at play that are going to drive markets and also appreciate that the playing field here is not the same as what we're seeing in the rest of the world. At a more practical level, this means that if you put a query through a non-Australian exchange, chances are they'll be contacting you during non-Australian hours. If you have a complaint, you're not going to be able to go to an Australian complaint resolution authority or body. If you're going to mint an NFT, the chances are that drop time isn't going to be in your time zone. So you're going to have to wake up at a wacky hour or, stop what you're doing in the middle of work just to mint it. If you're going to put funds into a yielding account somewhere, chances are those funds aren't going to be held with an Australian company. If you're going to place a trade, chances are the person taking the other side of that trade is not in Australia. As much as we like to think of crypto as decentralized, the counterparty you're dealing with is usually in another country, which can have a whole plethora of implications, especially if you get burned on a deal and you're looking for some kind of legal recourse. When I'm using crypto, especially when I'm dealing with CeFi, I always try to find out which country it's in. On another but still related note, I'll move on to our next topic. The second thing you should know about crypto is that US dollar still runs the world. When the institutional pillars of crypto started to form, and I'm talking your very old CeFi companies, Mt. Gox, Coinbase, Bitfinex, Tether, it was very difficult to open up a bank account to receive customer funds. Banks perceived cryptocurrencies as huge money laundering risks, and to this day there's still a widely held perception that a bank who serves a crypto company puts themselves at risk of helping a business that's facilitating money laundering. Now, these money laundering fines are no joke. In the last couple of years, CommBank got slapped with a $700 million fine, and Westpac got slapped with a $1.3 billion fine for breaching anti-money laundering rules. We're also seeing some enforcement actions overseas with some really hefty fines as well. As your average bank director or bank executive or manager has a relatively low knowledge level about crypto, you can see why they're freaking out about the prospect of facilitating cryptocurrency transactions and increasing that AML risk. Unfortunately, this has led to some major headaches for crypto companies, as they couldn't get customer funds onto their platform without a bank account. Or worse, they have a bank account that's being used to send and receive customer fiat currency, but the bank shut it down without any warning or explanation. This is called debanking, by the way, and it is a huge issue to this day, and I'm going to definitely do an episode on this. But for now, I digress. So, we're in a situation where exchanges can't get bank accounts to take customers' fiat currency, or banks who saw enormous frequencies of transactions running through their existing accounts from users depositing and withdrawing crypto, freaked out and shut these accounts down. Well, the crypto market said, if you're not going to let us load our national currencies onto our exchanges, we'll just do everything with stablecoins. Cue Tether. Tether was the Panadol to the exchange's headaches, as now there were far fewer fiat to crypto conversions requiring bank account and wire transfers. A customer's crypto investment journey changed dramatically. While they started going in and out of fiat to crypto and crypto to fiat every time they bought or sold a cryptocurrency, they now went from fiat to crypto once and could keep their funds in crypto when they wanted to realize investment gains or make a payment. The only time an investor would really need to convert back to fiat currency is when they chose to transfer their investments out of crypto and back into the fiat bank accounts. This made life a bit easier for the exchanges, as they only had to deal with fiat once or twice in the investment lifecycle, as opposed to every time a crypto was bought and sold. You might wonder, but why USD? Well, the US dollar is the global reserve currency. Most imports and exports are denominated in USD, and it made a lot of sense for a decentralized asset market to be denominated all in one currency. The prevalence of Tether and eventually other USD stablecoins became so popular that it quickly became very viable to run a cryptocurrency business with no ability for users to load fiat currency. They could simply fund their trading accounts with stablecoins or any other currencies and just do crypto to crypto transfers. Love 'em or hate 'em, what Tether did was lubricate the crypto ecosystem. And as an aside, I'd love to do an episode on Tether's history, but I probably couldn't do it justice. Shout out to the podcast Crypto Critics Corner by Cass Pianzi and Bennett Tomlin. Their first few episodes were all about Tether, and they gave a very thorough recount of Tether's story. Overall, the guys at Crypto Critics Corner take a very cautious stance on cryptocurrency, which is really a breath of fresh air in this space, as there's a lot of shills and outlandish, bullish predictions in the media. But again, I digress. There isn't a lot of conversation about how much soft power the US government has over the cryptocurrency industry as a whole. If the powers that be wanted to tank the greenback, crypto would not be immune. Now, I say tank the greenback like it's an easy thing to do. It's not. And that type of crazy hypothetical would hopefully never come to fruition. I just say it to illustrate my point. The US has a lot more power in crypto than you might think, and US stablecoins aren't likely to go away anytime soon. Overall, the US dollar's dominance in crypto means that Aussies will more often than not have some kind of foreign exchange rate risk. While you're probably always keeping your eye on the crypto market, it's usually a good idea to watch the US-Aussie FX pairs as well. You don't want to think your crypto portfolio is tanking just because the Aussie dollar is getting stronger. If you're trading big money or aiming for a low-risk stablecoin strategy, it might be a good idea to think about your FX hedging options. And I definitely want to do an episode on low-risk, stablecoin only strategies because there's a lot out there. But for what feels like the millionth time, I digress. On to the third thing you should know about crypto in Australia. Number 3. When it comes to payments, Australians have it pretty good. What supports 24/7 payments with just an email address or a phone number, and transfers occur in basically a blink of an eye? The New Payments Platform, or NPP for short. The NPP is a national infrastructure developed through a gargantuan collaboration between 14 of Australia's major banks, and not so major banks, and some payment providers. With the NPP came pay IDs instead of bank account names and numbers and BSBs. Through the NPP, users could use the exact same pay ID and transfer it between different accounts that they own, or even different accounts at different banks. On top of that, the NPP provides instant transactions and data-rich transfers, supporting a wider number of characters per transfer. And it's usually applicable to small payments, but that's usually just under a few $1,000s, so pretty perfect for everyone's day-to-day needs. The NPP allows for free and instant money transfers nationally, which outperforms the most popular blockchains in terms of peer-to-peer transfers from the perspective of cost, transaction speed, and user-friendliness. Now, don't get me wrong. The NPP doesn't solve all of Australians' problems, as cross-border remittances which aren't supported by the NPP can still be very expensive and slow. Also, not everyone uses a bank that supports the NPP. However, this new system does take a huge chunk out of the need for crypto-based payments in Australia, and it will take another chunk out of that need, as the NPP is being developed to support overseas payment systems in the future. I can think of 2 major factors which give crypto a leg up on the NPP: decentralization and anonymity. Decentralization is an increasingly important factor when we look at business continuity and security. The control and security of the NPP and its related services relies really heavily on the companies that develop and maintain it, whereas Bitcoin could get banned in the US tomorrow and miners would simply move country. The migration of miners would result in a temporary decrease in Bitcoin's hash rate, but we would expect to see that bounce right back up as new miners came into the game and existing miners go and re-establish themselves elsewhere. We saw this in China pretty recently. All in all, payment systems such as decentralized blockchains running on proof of work are likely to be more resilient systems than the NPP. The other area where crypto beats the NPP is anonymity. However, I really question how many people value that characteristic of a cryptocurrency and how long anonymity will remain a characteristic of crypto. If you open up a wallet that's not on an exchange or other CeFi platform, then sure, you can transfer wealth and make payments anonymously. But along that journey, you'll probably need to transfer fiat to crypto at some point, which means that someone somewhere is taking your ID. In addition, many governments are looking into making identity verification a requirement for decentralized exchanges such as hot wallets like MetaMask, making anonymity in crypto that much harder to preserve. There are some crypto solutions that are looking into solving this identity verification issue while maintaining users' anonymity. Some of these projects use some more technical methods like zero-knowledge proofs to achieve this, and I might do a deep dive into these types of projects at a later stage. For now, know that the NPP is going to be a close competitor to crypto remittances in Australia. The race is on between the two, and I'm watching this race very closely. The fourth and final thing I want to talk to you guys about today is that crypto regulation down here is very light on. It's so light, in fact, that we basically have companies begging regulators for some more rules. So, right now, if you want to be a crypto exchange, you need to register with our regulator for Anti-Money Laundering Counterterrorism Finance, or AML-CTF. That's AUSTRAC. Registering with AUSTRAC means that our exchanges have to do Know Your Customer Identity Verification, or KYC. After verifying your identity with KYC and checking that you're not a politically exposed person, exchanges are allowed to give you services that let you change your fiat into crypto and back. They also let you open up a wallet to store the crypto that you've just bought and send and receive more crypto to their platform. But that's it. That's the extent of the clear part. You see, everything else to do with crypto, having a wallet, cold storage, staking, DeFi, minting NFTs, collateralized crypto loans, trading with margin, ICOs, voting in DAO proposals, that stuff's not in AUSTRAC's purview, and there's no clear regulation directly addressing that stuff. See, that stuff needs to all go through a lengthy assessment process to determine whether or not it's a financial product under the definition of financial products that are set by the Australian Securities and Investment Commission, ASIC. And that assessment doesn't look too pretty, especially since the definitions of these financial products were defined way before crypto went into the mainstream, so the definitions aren't really fit for purpose. What that leaves crypto companies in Australia with is a big question. Am I dealing in a financial product? And this is a super hard one to answer that requires a lot of legal advice, since a team of lawyers usually has to come in and look at the characteristics of each cryptocurrency or product that the company wants to offer. Then they have to make a decision as to whether the product that they want to offer or the crypto they want to offer fits into one of the existing financial product categories. Does your token have voting rights? And do your token holders have a claim to the residual assets of the underlying project, kind of like a DAO? Well, that ICO is starting to sound a lot like an equity raise where you issue securities. Is your token like Polymath, which tracks the price of a stock or a foreign currency? That kind of sounds like you're issuing a derivative security or a contract for difference. Are you like Binance or FTX and you play with leverage on your exchange? Sounds like you're dealing with a little bit of margin and maybe some contract for differences. Is your ICO used to invest in a range of other assets which generates a yield for your business or token holders? Okay, that's starting to sound like a mutual fund. Now, these are just a few examples of how someone could interpret a cryptocurrency to be a financial product. And that's the thing. There's an element of subjectivity until it gets put into regulation. Until that uncertainty goes away, we're probably not going to see much innovation from Aussie CeFi products that come to market, because it's Aussie companies behind those CeFi projects that don't want to get into trouble with ASIC. Now, overseas, it's a bit of a different story, because overseas companies aren't answerable to ASIC. But if you're an Aussie, you probably don't want to get on ASIC's bad side. We did see this when Binance Australia turned off their margin trading to Australians, because they didn't have a financial services license to offer margin trading. Recently in the US, we saw Celsius and BlockFi get banned from a couple of states since their regulators deemed their yield-bearing accounts to be securities, which neither of these companies had permission to issue under the local state laws. Another huge example in the US is the Securities Exchange Commission, or the SEC, suing Ripple right now for getting this financial product determination wrong. To my knowledge, our equivalent regulatory body ASIC hasn't gone after anyone in the same way its American cousin has. Overall, the regulatory ambiguity around what a cryptocurrency actually is creating a lot of uncertainty and risk for Aussie crypto companies. If I was an investor, I wouldn't be surprised to see companies holding off on cool products like yield-bearing accounts and crypto credit products until they knew whether or not they were going to get stopped by ASIC. It's not all bad news though, as ASIC has consulted with the industry on releasing some guidance for ICOs, crypto-managed funds and ETFs, which I'll link in the description. A recommendation also came out of the Senate to conduct a crypto mapping exercise to figure out which crypto products fall into which financial product categories, which will help companies determine what licenses they need to offer the products on their roadmap. I'll definitely do an episode on these Senate committee recommendations, as it gives a really good idea about the discussions that are being had behind the scenes and in Parliament. There's a lot happening beneath the surface when it comes to crypto regulation down under, and you guys should definitely keep an eye out for any news. Or, alternatively, let me keep a finger on the pulse for you, as I'm watching this space very closely. And that's it. That's 4 things that you should know about the crypto industry in Australia. While there are only 4 overarching topics in today's podcast, hopefully you got a taste for a few more meaty subjects in crypto, like the role of stablecoins, the popularity of crypto as an alternative payment system globally and nationally, the strength of our domestic payment system, US influence in crypto, debanking, AML/CTF rules, anonymity, privacy, regulation, and our financial product woes. If you want to speak to me about any of today's topics in more detail, or you've got any questions or feedback about anything else that came up today, or if you even have requests, please feel free to shoot me an email at theaussiecryptopodcast@gmail.com. Thanks for putting up with my voice and listening to the Aussie Crypto Podcast. Hopefully you got something out of the episode. I promise I'll get some other voices from pros in the industries on soon. Thanks everyone. Hope you stay corona free and take care.